Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today I'm going to explore the evolution of fixed income markets with Phil Sickler, institutional services and fixed income specialist at Jane Street. And in case you're not familiar, Jane Street is a quantitative trading firm. They are a global liquidity provider and market maker trading equities, bonds, and ETFs worldwide. They're one of the largest ETF liquidity providers in the world for ETFs. And Phil is a member of Jane Street's institutional sales and trading team. In his role, Phil partners with institutional clients to provide trading solutions, access to Jane Street's differentiated liquidity, and engagement on electronic trading venues. And during his tenure at Jane Street, Phil has helped build the firm's bond trading desk and grow its institutional client-facing ETF business. Phil, welcome. How's it going?
Great. Thanks for having me, Ed. It's a pleasure to be here today.
So we're going to talk about the fixed income markets and the evolution of the fixed income markets over time. And when you joined Jane Street, just kind of the growth of the team, how many people were focused on fixed income at Jane Street when you started?
So back in 2009, when I joined in February of that year, I think there was about 6 of us globally that looked at fixed income on a full-time basis. The firm was relatively small at the point. We were about 140 or so employees spread across various trading offices across the globe. And I kind of think about fast forwarding today to the growth of fixed income ETFs and the growth of the fixed income market in general. We have north of 50 investment professionals looking at fixed income across our desks in New York, London, and Hong Kong as well.
Now, have you always been in the fixed income space?
I have. I have. I graduated college in 1997 and started in middle office and operations roles, focused on fixed income products very early on, and have been in the space ever since. So I've moved along the kind of career trajectory of ensuring that the pipes and settlements work all the way through into the trading and sales part of the business.
Was it something you knew you wanted to do, or did you know you want to do fixed income? Or
to be honest with you, I never really expected myself to be a fixed income professional. Growing up in Queens, New York, you're always exposed to the financial services sector with Wall Street and the cover of the papers, the stock pages back in the Wall Street Journal. And there was always a little bit of a pull, but I don't think I ever expected myself to be in fixed income or equities. And quite frankly, when I went to college, I had zero expectation that I was starting a college degree with a trajectory to end up in the financial services markets. I actually started it in chemical engineering, quite frankly. And my father had tried to convince me to get a degree in chemical engineering to focus on a career in the fragrance industry.
Fascinating. Yeah, you talked a little bit about kind of finding your way into the business and having a certain grit. What characteristics do you think that you've recognized in yourself have helped you in your current role and in your career?
Being able to listen. I think being able to listen is important, both externally and internally. I think it's important to recognize that you're in a piece of an equation. Sometimes you have to take constructive feedback to heart and really digest it and absorb it and think about it in ways that it applies to yourself, and recognizing where your strengths and weaknesses are. Some other things that I think are really important is having the desire to learn, right? And to be able to draw anomalies and broader understanding of things that you may not be necessarily required to understand in the seat that you're in. And I think that's become a very valuable aspect for my growth within the fixed income ETF ecosystem, and also within just the overall ETF ecosystem. So I think, not being too proud, right? And understanding where you have to raise your hand and, it's not necessarily accept defeat, but to be practical about the situation. I think that's a lesson that I really, it took a long time to learn, right? I think it's not very obvious as a human being when to say, hey, this is where I'm capped out, right? But I think it's important to try along the way because there are things that you take away that will pay long-term dividends.
Now let's talk a little bit about your current role. Can you describe a little bit about what you do currently?
So a lot of my focus really is on helping our institutional client base access Jane Street's liquidity provision. That's across ETFs, regardless of asset class, although I have a specialization in fixed income. Our corporate bond offering, I work closely with some different electronic vendors on the fixed income side for thinking about how we redistribute risk into the market and respond to various client order flows. I work closely with ETF issuers, so that might mean talking with our ETF market making desk about indicative pricing around an existing or new product, talking to sales representatives from different ETF issuers about mandates that they're working on and distribution channels that they're focused within. So it's a pretty extensive network of individuals internally and externally that I liaise with on a daily basis. There's trade coalitions that you talk to and different regulatory body conversations that come up. But I do think a significant portion of my focus is really bent around fixed income and fixed income ETFs and helping to enhance the general education of fixed income ETF products within the broader investment community.
When you mention institutions, are you talking hedge funds, pensions and endowments, or are you working with financial advisors, for instance?
It's a great question, Ed. So our client base at Jane Street on the institutional side ranges from asset managers through asset owners. The asset manager side, you're talking about the big money managers down through smaller money managers, and as well as the hedge fund community. The asset owner channel, you're talking insurance, pension, endowments, family offices. We do interact with quote unquote retail platforms, which are institutional in nature. Those are the custodians, the wirehouses. So we do interact and talk to RIAs. RIAs that are able to trade on their own behalf are the ones that we typically interact with. The ones that are managing their money, but it's executed by a third party, will have the relationship with the third party. So it's a nice group of firms. So it's been a very nice development at Jane Street since 2014 when we went client facing in the ETFs, and in 2018 when we went client facing on corporate bonds.
Now, let's talk about the fixed income markets kind of in general. And given your career span, how have you seen markets evolve over the years? Have they become more democratic?
They have. And democratization has really been spurred by the growth of fixed income ETFs. When you look at the fixed income market, it's big, it's broad, right? There's all different product silos. You're talking government bonds, you're talking corporate slash credit. There's the mortgage market, there's the structured products market. Many aspects of that market were inaccessible outside of the institutional space. But the growth of fixed income ETFs has allowed more market participants to interact with these different products. So it really feels like fixed income ETFs, as the growth of debt and indexation has allowed for more products to become available. What we've seen is ETFs have allowed for a greater level of price transparency. These products trade on exchange, right? So whether you're an institution or you're retail slash advisor, you can see where fixed income ETFs are trading, right? That pricing information is there. And I think that has allowed the markets in fixed income to become more accessible and more democratic because there's less information barriers in the market for participants to have to deal with.
How would you characterize the differences between institutional investors and, say, retail investors?
Yeah, so that's a really good question. So I think from a difference perspective, when I think about institutional versus retail, I really think about the focus being centered around size of transactions and time horizons, investment horizons. retail have become significant users of fixed income ETFs over the last decade. I mean, retail was probably much more anchored around mutual funds prior to the growth of fixed income ETFs. And retail, when you look at the equity world, they're investing a lot of times in themes, right? Obviously, there's individual security selection that's taking place, but there's one ticker for a stock, right? If you're trading ABC company, there's just ABC stock to buy on the exchange. But ABC company might have 50 bonds. They might have 150 bonds. So retail investors have had a little bit of a harder time navigating the fixed income market because of some of those differences at the individual security level, right? You're talking about differences in seniority of different bonds, right? When you're talking about debt and bankruptcies, you have different indentures or covenants that might exist in different securities. Retail, as much as they've been fixed income investors for a long time, they've been kind of handcuffed in what they could do because their access into the market wasn't as liberal or easy as it was for institutional investors who are trading larger sizes and leveraging the traditional over-the-counter network for the exchange of those bonds to move from the buyer to the seller through the intermediated market. And in equities, you have exchange trading and everybody's able to come and interact with one another. So the differences in how those order types are handled sometimes creates those differences. But I think at the end of the day, it does feel like there are more similarities between the retail and institutional community than there are differences.
Yeah, no, absolutely. One question I was going to ask you about was just kind of your take on the friction costs of trading for retail and institutional. I mean, how have those come down, or have those costs eroded, those differences eroded over time? The kind of one of the stories that we would talk about selling ETFs is that it can be more cost efficient for an individual to trade a fixed income ETF than try to buy the individual bond itself.
That is definitely something that I think over time has become a much more significant topic of conversation in the market. Historically, I think there's been a fair amount of analysis done that the retail bond investor at the individual bond level pays a higher transaction costs relative to his institutional peer. And a lot of that has to do with the fragmentation of the fixed income market. And I think this is where both retail and institutional grapple with some of the same problems, right? There's bonds everywhere. They're all over the world. And a significant portion of the bonds are in the current environment are held by institutional investors. When a retail guy is trying to buy $1,000 of a bond, the means by which they're doing it sometimes isn't very fluid. And that's why those transaction costs were higher. They were going through an intermediary who was going somewhere else to find it. So there were some markups along the way. And in the institutional space, if you're talking, instead of 1,000 bonds you're buying, you might be buying 5 million bonds. Transaction costs ends up being smaller because the seller quite often is incentivized at that size to do that trade. Whereas at the smaller piece, breaking off those smaller pieces sometimes warrant additional transaction cost for the technology and the personnel that's involved. So I think where retail has actually benefited over time is it's twofold. To your point, the growth of the fixed income ETF market has reduced costs, and that's for a variety of reasons. One of the other ways where the costs have been compressed is the retail broker-dealer community has spent a lot of resources over the past few years connecting to multiple venues, electronic third-party vendors, or different broker-dealer platforms to shave off some of those frictional transaction costs. So those retail brokers are helping to bring institutional pricing on the individual corporate bond level to many of their clients because they're able to aggregate orders together. A couple clients who want to trade 10,000 of a bond, all of a sudden you have 100,000 order, or you have a 500,000 order. So that helps to compress the cost. But to your point, fixed income ETFs have really allowed folks to experience compression in transaction costs because fixed income ETFs continuously trade on exchange, right? So you have less capital costs for holding inventory. So some of these ETFs are trading back and forth on exchange all day long. And that velocity of trading compresses those frictional transaction costs because somebody's not sitting on a bond for days, weeks, or months trying to sell it where they don't know who the natural buyer is, right? And in ETFs, when you see that ADV, it's easy to say, okay, this product trades X amount of shares a day. There's liquidity in it. And then there's this second layer of liquidity where the ETF, being a wrapper of bonds, shares can be created and shares can be destroyed or redeemed, right? So the underlying securities keep coming in and out of that ETF, which creates more liquidity in the market, which helps to reduce those frictional transaction costs as well.
Can you speak to some of the perceptions that some people have about fixed income ETFs? Some think that there will not be that liquidity there in a stress environment, and that's the reason why they want to buy and hold the individual bond.
Yeah, that's been a conversation that I've probably had since 2014 on a regular basis. I think it becomes a conversation that you need to get to the point where you're comparing apples to apples. And I think historically the conversation was a fixed income ETF is an orange and a mutual fund is an apple. Both products carry some similar characteristics in terms of what they're trying to do, right? They're trying to get exposure to the market. But with fixed income ETFs, they trade intraday, whether you're an institution or you're retail. If you want to buy 100 shares of a given ETF, you can do it right now. And that position ends up in your book. So you can see the economics of what took place and you're bearing those economics. For a mutual fund, if you're transacting, you put your order in, and at the end of the day, you end up with your position and you enter your position, I believe at NAV, right? It's the end of day NAV that gets struck. So a lot of folks have viewed ETFs as this product that they didn't thoroughly, I think, appreciate the liquidity profile of. And as a trader, somebody that traded for a number of years, there's multiple inputs that go into thinking about cost, right? It's your size, it's the price you're looking to get done at, and it's your time horizon, right? How quickly are you looking to execute? And in ETFs, that execution is immediate, right? There's continuous liquidity on the exchange. There's the over-the-counter market that you can interact in, but you know where that trade is getting done. So just because I, as an owner of an ETF, want to sell that product does not necessarily mean I'm going to get the price that I see on the screen. And I think for some folks, when certain trades go through the market, it raises questions saying, hey, well, I thought it was worth X, or say call it 100, but I sold it at 98. So I sold it $2 down or 2% down. Now, if you had a corresponding mutual fund flow, that transaction could actually take place at the same level, but it's not necessarily obvious because of some of the other math that goes on in a mutual fund product. And I think we need to look at all of the different points in the market over the last 6 or 7 years to look at the stresses that fixed income ETFs in particular went through and reflect how did they perform, right? And this past March, we had unprecedented market liquidity in credit. It hit the rates market, US Treasury market. There were definitely instances where fixed income ETFs traded at levels that people maybe didn't expect them to, but there was a liquidity vacuum going on where a lot of the underlying bonds weren't trading at all in the market, but the ETF market was trading. And that liquidity becomes important. And I think a lot of this gets lost in conversation when people revert to, well, something traded more expensively than it was expected to, right? It's the on-demand function of the market and then what risk transfer costs. And during periods of volatility, it costs more to trade, right? You're asking somebody else to warehouse a position and they need to be compensated for that. But every time we've seen volatility hit the market, all we've seen is an increase in ETF trading volumes on exchange. So that in itself, I think, becomes the true validation of the product.
From the market maker perspective, in an environment like that, I guess actually in any environment, what are the inputs that a market maker might be looking at in terms of offering a price, particularly when some of the bonds don't trade frequently? How do they come up with a price that they would offer to somebody wanting to transact in a fixed income basket?
That's a great question, Ed. If I give you the full inside scoop, I'm going to have to hunt you down, right? So there's obviously some proprietary information that goes into these calculations, but look, you bring up a great point. In 2019, SIFMA did a study, and one of their published results was that 35% of the corporate bond market has a two-sided prices. So as a market maker, we're thinking about how much different information we could digest to pull into the calculations. So there's a host of third-party data vendors that are out there, and they're very important in the grand scheme of how ETFs are getting marked. We look and leverage Trace, right, the trade reporting facility to see where bonds are trading. And then you leverage financial models, right? So a bond from one company, you might get a couple bonds from one company trade, and you use that to extrapolate out the curve for the rest of the bonds for that company. Where there's less data, you might look at similar comps from the same sector. You leverage other financial products that are in the market. You might think about historical correlations of how investment grade credit spreads become impacted by moves in the US Treasury curve. One of the really important variables for us is looking at the ETF market, because we think it is a leading price indicator. And we do look at, the velocity of the flows that are going on in there. So if one product seems to have selling pressure, right, you're identifying where you think you can buy that ETF. You're thinking about the creation and redemption mechanism in terms of kind of the historical verbiage of arbitrage trading, right? If we're buying an ETF, at some point we may not want to own that ETF if we don't see a clearing level for buyers to come in, and we'll redeem that ETF and try to go out and trade the underlying securities through the market in a way that has the least amount of impact. That latter process helps to identify if you're correct in where your pricing should be. So in very kind of normal market conditions, if you don't have a lot of live market data available to you through those pricing vendors or trading information on the underlying corporate bonds, you're relying on kind of that two-way exchange liquidity. As that liquidity becomes skewed to one side, right, there's lots of sellers or lots of buyers, then you rely on that underlying bond market. And the longer it takes to recycle that risk, the more you're going to charge to provide that liquidity. And at some point, the market should be efficient in the sense that somebody thinks the valuations are at a point where they're going to either step in to buy, or if they're stretched, right, there's a lot of buyers in the market, they may step in to say, well, it's time now to sell. And that's one of the unique features of the ETF, in that creations and redemptions allow for more efficiency because they allow the liquidity provider to think about the most efficient ways to recycle that risk through the market. So we might be buying an ETF, but be happy to redeem that ETFs for its underlyings and use those underlyings to create other ETFs. So the bonds may not even touch the underlying market. So there's this fungibility element within the ETF market that is unique in itself. And as a global market maker, we're able to leverage that across our platform through our desk in New York to London to Hong Kong. And that helps to deliver a better overall experience to clients who are looking at trading these products. And I think that's one of the coolest features about the fixed income ETF market at the end of the day.
Let's finish up on ETFs a little bit. Just maybe you have some best tips for trading fixed income ETFs that investors can keep in mind.
Yeah, I think trading ETFs, it's similar to trading equities, right? They trade on the exchange. So I think one of the important takeaways is leveraging trading protocols that you would use in the equity world. So most ETFs have a fair amount of liquidity on exchange. But it's important to thoroughly understand that. So maybe not using a market order to trade every ETF, because some of them only have a certain amount of liquidity at the top of the stack. So what you don't want to do is send down, I want to buy 10,000 shares, and there's only 4,000 shares of liquidity near the top of the stack, all of a sudden you're buying, and you go from buying it at the market value to trades up six points. That's not a very pleasant experience. One of the other really important things as an investor is understand what you're trading. All of these ETFs, they have a prospectus, they have a description, they talk about what they invest in, what the profiles are, how much of a product is, if you're looking at a long, like a broad index product in investment grade, it could own bonds that are from 3 years to 30 years. Well, maybe you don't want that specific exposure, right? So you should know what you're buying, right? It's like shopping on Amazon. As an institutional or retail investor, you should do your due diligence. I think it's important to have conversations with your trading relationships, whether it's going through a custodian or it is being handled by a third-party trading platform, to understand how they're interacting with the market, who the different liquidity providers they use. I think it's also important to have relationships with ETF issuers, right? To get a better understanding of what the products are, how they trade in the market, if there's any specific differences in a product that may not be obvious to others. So like one area that I think about, right, is the international fixed income space. ETFs can give you access to parts of the market that you can't access as a domestic US resident per se, right? Like if you wanted to trade some different Latin American bonds, you don't have access to those as an outright investor. But through an ETF, you can get access to that. But understanding what are some of those characteristics and differences can be important. So that's generally kind of what I think about best practices. Sometimes we've heard avoiding the opening auction or the closing auction because there's a lot of volatility. Maybe volatility is not the right word. Velocity of trading that happens there, right? That's probably one of the important things. And then I think if you're looking to trade certain products in size, maybe trading earlier in the day is better, right? Because as an ETF market maker, if we trade a product in size earlier in the day and we're looking at how much of that product is going to trade over a given time period, we may need to have a conversation about doing a creation or redemption. And in certain products, there are cutoffs with the ETF issuers when those orders could be placed. So now that the ETF rule is going fully into effect, we're seeing more issuers move into what's called the in-kind creation process, where securities can transfer from a market maker's balance sheet to that issuer's in a way that's beneficial for the ETF portfolio management function within that ETF. So it's better to have those conversations earlier in the day than later in the day. Bond liquidity does start to dry up later in the afternoon, but you can trade bonds after the equity market's closed, which is always a nice feature, and obviously before. So I think those are kind of my most of my best practices thoughts.
What's one long-term trend you see playing out over the next year or several years?
I think the trend that is going to continue, and I'm going to sound like a broken record here, Ed, is we're going to see more and more institutions use fixed income ETFs as a core part of their portfolio. I mean, I remember 2008, fixed income ETFs were 30 billion. I mean, what's the number now? We're talking they're over $1 trillion. It's a real number, but it's also a very small percentage of the overall market. And that's why the growth opportunity still sits there. The credit market in the US is about 10 trillion in assets. The treasury market is about 17 trillion in assets. When you think about investment grade credit risk in the US, I think fixed income ETFs represent anywhere between 5 to 10% of the daily volume of the underlying corporate bond market. In high yield, that number is actually much higher. It's closer to 20%. And the reason why is it's hard to find some of those bonds. So the ETFs provide that access point to all investor types. So it really, the trend of adoption of fixed income ETFs that we've seen, and we've heard a lot of different market participants talk about, that's our obvious choice of the trend that's going to continue next year and into the foreseeable few years after.
You ready for our lightning round, trend or fad?
Sure.
So I'm going to mention 3 different topics, and you can tell me just quickly trend or fad in your opinion.
Yep.
Pandemic puppies, trend or fad?
It's a trend. Now, the reason I'm going to say I have 4 dogs and 2 cats, like it's the band of misfits. They're all rescues. So, yep, I think it's a trend because we're probably going to be working for home for several more months, right?
Connected home fitness, trend or fad?
Trend. I've bought a couple things that I'm still waiting to have delivered. So
All right. And cryptocurrency, trend or fad?
it feels like it's a trend. It feels like it's a trend. It does seem like there are deeper institutional conversations about crypto products taking place in the market. I mean, those conversations feel like they've been happening for quite some time. To me personally, they feel like they're starting to get a little bit of a foundation to them.
Phil, this has been fantastic. Thank you very much for your time and all your insight.
My pleasure, Ed. This was great to do. Thanks again for having me, and I look forward to seeing future episodes.
And thank you for tuning in to another episode of Trends with Benefits.